Welcome back to Good Returns. I'm Matt here with Garrett, and we are very glad that you have stumbled upon our humble podcast today.
Yeah, we're really glad you found us. This week's episode feels a little timely because there's been a lot of noise, a lot of headlines, a lot of movement in the markets. I think a lot of people that may be listening right now are trying to figure out what to pay attention to and what to sort of ignore. What's the noise?
Yeah, which is honestly most weeks if you've been investing for any significant period of time, whether it be in your 401k or in your brokerage account or with your financial advisor. But some weeks are a little more interesting, a little more exciting.
Eventful, yeah.
Eventful. This past week was definitely one of those.
We're still in it. This is Friday.
This is true. We are still in it, wrapping it up.
Wrapping it up. Quick note here. We will say that this show is for educational purposes only. We are not, we may not be, we could be your financial advisor if you're watching this. We may not be your financial advisor. You may have a different financial advisor. But these are sort of concepts that we're talking about, real world news. We'll get into some planning topics later. Nothing we say is personalized to your specific situation. You definitely need to sit down with somebody wherever you are and figure out what that means for your personal situation. Blanket statement here. There's our disclosure.
Yeah, absolutely. And it's always great to get that and understand it because you hear a lot of advice and talking heads. And you just have to remember, if you don't have a personal relationship with that person, whether it be on the radio or on YouTube, take the information in, digest it, but also there needs to be a little bit of a grain of salt to it as well, because everybody's situation is different.
Yeah, I think ideas are good, but you have to figure out how to implement that idea for your situation.
That's exactly right.
You see this a lot on social media, Facebook, Instagram. They constantly have the financial influencers talking about why you should take Social Security at 62 or why you should do a Roth conversion or any of those types of things. All good ideas. They just need to be thought out fully.
Yeah, absolutely. Well, let's look at what the stock market did this week. Okay, so
how did the stock market do this week?
Last week, let's back up a little bit. So last week we talked about Israel striking the South Pars gas field, which until last week nobody ever heard of that name, but it is a large gas field. Caused physical damage to energy infrastructure. Obviously, doesn't get repaired quickly. Now that helped create the framework or the context for the understanding of implications concerning more long-lasting disruptions to energy supply. So it kind of brought that into the forefront, at least the news cycle did. And this week we got a taste also of so last week was the South Pars field, kind of, again, brought that energy infrastructure information into the forefront of our mind. This week we got kind of what diplomacy looks like in the midst of a heated conflict. There's actually a term, it escapes my mind, but there's actually some vernacular that's used to describe the type of diplomacy that's taking place. The term escapes me. It's nothing really that interesting, but essentially maximum pressure with diplomatic off-ramps. It's been used periodically throughout the last few decades in certain instances. So we're kind of seeing how that plays out, creates a very wild environment.
Yep.
To say the least, a lot of headlines, a lot of clickbait, but then also a lot of valuable and useful information too. So it's definitely been a wild ride.
Yeah, it has. We saw on Monday the White House came out and said that they had negotiations, ceasefire talks with Iran. They announced a 5-day pause on strikes against the energy infrastructure, and oil dropped more than 10% on that. One day. Yeah, it's pretty volatile. Stocks rallied. The S&P was up about 1.3% on Monday just alone. So we saw definite headline, and that's what's moving the market. And we'll talk about that in a little while. But, if you looked at your account on Monday, you probably felt pretty good.
Yeah, Monday was a really, really strong day. It shows you the power of how, we spoke about on Friday, how you can't really, your first order effects that you think are going to occur from news, and then the things that the headlines make you aware of, you got to be very careful with it. Because if you opened up a position of oil on Friday, you lost your shirt on Monday. And especially if your future's trading with leverage, a day can make all the difference. So you do kind of have to be careful about that.
Yeah. So we fast forward a little bit. Iran effectively said, we don't know what you're talking about as far as the White House is concerned and the negotiations and all that kind of stuff. They denied the active negotiations. They rejected the formal ceasefire proposal, and oil kind of reversed. Stocks pulled back. By Friday, you got the S&P. Friday today, as we are, S&P has given most of the gains back, finishing the week we don't know, somewhere around 1.5% down. I mean, I think we're a little bit down today. We can check it out. We're down 0.5 point today on the S&P. So
that was a net negative on the week, but the real story is the whipsaw. You know, especially as you're either, using your retirement account to fund your lifestyle in retirement, or whether you're contributing in your 401k. Short-term moves mean absolutely nothing. They are to be ignored. But that the real story in the market movements is that whipsaw. And I think that it
was quite a whipsaw.
Up big, down big, all driven by headlines, change direction within 24 hours of each other. And that to me, well, I guess we'll get into this in a second. I'm getting ahead of myself.
Foreshadowing.
I'm foreshadowing.
Yeah. So if we take that and look at like credit yields and spreads and treasuries and look at that, treasuries ended the week higher despite falling midweek. So the credit spreads are kind of tightening a little bit. This is maybe a modest kind of positive signal from the bond market. Volatility is staying elevated. You're seeing a lot of the conversation that we had a few weeks ago about mortgage rates. You're seeing that sort of reverse. Mortgage rates are going back up again, whereas we thought that they were going to kind of fall. And they still could over the long term, but this is short term. And it really kind of illustrates the fact that the market that we are in right now is 100% headline driven. There's no other way to look at it. It's headline driven. When you see something in the headlines come out that moves the market immediately, you're not in an environment where the market is necessarily trading on earnings or, the economy, I guess. Well, although you could extrapolate that from it. If it's a prolonged thing, it could have some effect on the economy, I guess.
It is worth noting what happened on Monday with oil and stocks, because it tells you something, important, how the market or how the price movements, I'm not going to say the market, and I'm going to tell you why, how the price movements in the market are interpreting all of this, or how you can interpret the price movements. Oil dropped 10% on potential ceasefire negotiations. Stocks did not go down with it. Stocks went up. We have a correlation that is negative. There's a zero correlation occurring. Falling oil was being read as a signal the conflict might be resolving. So they both moved in response to the same headline in much different directions. Now, I will tell you that investors, individual investors, and even your market participants are not driving this, because there is nobody that is buying stocks on Monday and selling them on Tuesday at a loss. That is not happening. It is algorithmic trading that is using the market rotation and the thinness that will always appear during a market rotation, which we've been seeing, and we'll get into that in a minute, is using those thin order books in order to manipulate prices lower based on headline news. So when you're seeing these giant swings, you have to always ask yourself, who in God's name is going to buy AMD on Monday at 230 and then turn around and sell it at 200 on Tuesday? Like, who is going to do that with $100 million? Like, who's just going to give up $15 million in one day? It's algorithmic trading. 100%. That is what that is.
Algorithmic trading, we probably should define a little bit in case there's somebody listening that maybe is not aware of this terminology, or maybe they understand the concept behind it, but they're not aware of kind of the technical name for it.
Yeah. So there are many different ways to invest. We are big advocates of long-term investing, using a mixture of strategic and tactical allocations, meaning that we want to, in general, over the vast majority of time, stay invested. And we want to be invested in things that are going to give us the greatest probability of return with less volatility. That is our philosophy. So when you disregard all the things that I just said that you may not understand, the key point is that we're long-term investors. Right.
Yeah.
In general, we want to be exposed to assets that go up in value over time, regardless of what those assets are. We want to be exposed to it. There are also ways to make money in the market where, if you are moving significant volumes and you have both long positions and short positions, you have derivatives, you have all different types of exposure, you will be able to make money with high frequency trading, algorithmic trading in the short run, with large volumes of cash, all computer driven, and you start the day with open positions and you close the day out with all closed positions at your profit and loss. You may lose on one, gain on the other, but that difference could be $1 billion if you're trading with large volumes of money. You don't really care about the long-term price movements. You're trying to take advantage of dislocations in the market that could just be structural, based on market rotation, based on the money supply, based upon just the general movement of the market writ large. Headlines are a big proponent of that, because if the headlines can scare 100,000 retail investors of selling, $50,000 each of their position, then you can make a tidy sum taking the opposite end of that. So there's very complex systems that are driven purely by the short term. And as long as you're not reacting to the short term, you're not feeding into their profits, because your loss is their gain in those situations. So you're not feeding into that, which is why you never want to be a short-term trader. Very few people are good at it. Me and you digest this stuff every day. We have extensive experience with very complicated trading, and we will sit here and tell you that short-term traders will lose.
Yeah, probably. Yeah. I mean, there are exceptions to that, obviously, but you have, it's very hard. It's very difficult, and it's unsuccessful more than it is successful, I would say. Yeah. But people that go into it know that, and they know that they're going to be less successful in the majority of the trades, but the ones they are successful on more than make up for the ones that they're not successful on. It's just it's a very volatile way of trading, basically.
Yes, and when we're saying short term, we're not talking about tactical shifts and cash balances over, say, a 6-month period of time. What we're really referencing is day to day, 1 hour trade, next hour trade, next hour trade. That's really what we're speaking of. We are big proponents of tactical strategies that use market signals in order to better interpret the best place to allocate cash. Sometimes that is treasury bills. Sometimes that are things that are not as interesting or sexy as you would think, but it's still, total return driven over a methodical period of time using data. So all this stuff we're getting into the weeds on and kind of getting rabbit trailed. But the point is that when you see these giant price swings from day to day, that is not driven by average investors deciding to sell their 401k out of Walmart and to buy Uber. Yeah, it's just not. It's driven by much more complicated short-term price actions in order to try to take advantage with large volumes of cash, to try to make some money that day. That's really
well. You see this kind of in margin debt too, where you have like a margin call, and the margin sellers don't care what the price is of the underlying stock or equity position. They receive orders to sell and they sell, and so a lot of times you can see that kind of compound in an environment where the market is trending down. It may look like it's doing it, exponentially, and you're thinking, where's this coming from? And a lot of times those are some places that it's coming from. But if we talk about the volatility, that kind of moves us into the next section. We're talking about noting that we're still seeing, we took a little bit of a break like last week from this whole idea about the market rotation, and now we're starting to see that kind of rear its head again. So we've already talked previously about moving into small caps or moving into different kind of sectors of the economy or sectors of the market. It showed up again this week. So what do we think about that?
Yeah, the rotation, small caps, value stocks, things that we picked up on at the beginning of the year. We've mentioned one of our big rebalances, and again, this is not investment advice. This is backward looking, so we're not going to, give you data as to what may or may not be occurring now, but backward looking, we went through internally a big rotation, looking at the data and understanding probably your most upside with less volatility was going to be going more equal weight, going more value driven, looking into small and mid caps, kind of the average company in America. And that is absolutely outperforming. It has been consistently this year outperforming the market weighted indexes such as the S&P 500. We're definitely experiencing less volatility, and I believe that's gearing up and basing for what could potentially be a really good return for that strategy, and that's all potential, obviously, and we have to say that. So talking about that rotation early in 2026, that rotation did pause kind of at the height of the market stress, but this week we started seeing that rotation continue. It's very interesting.
You look at the S&P 500, which is down 6% year to date since the 1st of January, and you look at like an ETF for the equal weight index, and we are down like 0.64. We're down 64 basis points. That's a huge gap when you're talking about.
Tell me that difference again.
6% is what the S&P is down. The equal weighted S&P is down 60 basis points.
Yeah.
So it's a huge swing.
Yeah, it is a big swing. That's so for portions of the portfolio that are tilted for us more towards your equal weight and your smalls and your mids are experiencing significantly less volatility than the S&P.
Yeah, because you have a lot of the S&P made up of these giant tech companies that are not benefiting for whatever reason from they're rotating out. So I mean, even today, the Nasdaq's on 1.12%. We've got the Dow down 68 basis points and the S&P down 69 basis points. So you're seeing this again, even this kind of rotation happening underneath the surface, which is what you would expect to see in a sustained, healthy bull market. So none of this is like
it's not alarming.
Yeah.
It's positive signs. And it's extremely, when you put this on the backdrop, which we'll touch on here briefly in a minute on the AI productivity boom, when you're looking at it through that lens, it should be very encouraging because the money is moving towards parts of the market that have yet to embrace artificial intelligence. And when doing so, these smaller companies are going to be radically transformed.
Yeah, I think that is also, and again, we don't want to get on a rabbit trail, but I think that you're also seeing the real world effects of people having the technology for a little bit of time and understanding the implications of it. So it's not just like a pie in the sky concept anymore. People are actually using this to disrupt legitimate software service businesses and changing cash flow in a lot of cases with a lot of businesses. I mean, you're making cash flow decisions, you're making hiring decisions. It's yet to be seen if this is sort of an overreaction as far as the layoffs in mass of the workforce. But there's some sort of medium there that has to be found, and it'll be interesting to watch as we find that.
Yeah.
But we're even, in the last 6 months, it's changed drastically.
It's changed very, very drastically. We have really here at Momentum Wealth have embraced artificial intelligence to a degree that would probably be surprising to most people. Me and you have both.
Well, we just leverage it to its capabilities. We use it for what it's meant to be used for.
And we are seeing, just personally with us, we are seeing like, it's not like just the last 6 months, the change has been noticeable. It's not like, there's a new iPhone and it's got an extra button, right? It's like,
but I don't think that's
starting to accelerate in us being able to embrace it meaningfully, I guess.
Yeah, I think that we'll continue to see people using it in different industries in different ways. I'd always think about the other podcast we did, Fountain City Founders, where we talked to a business owner who was using it to sort of like act as a consumer, like, hey, this is what I'm selling. Mm-hmm. Give me some feedback on this. And she was able to push her business like much further than she thought it was without paying for focus groups or anything like that, because it's sort of taking that concept and allowing you to get access to it at $20, $30, $40 a month or whatever it is. And you're not having to pay a couple $1,000 for it. Or
free. So, I'm working on an undisclosed project that me and you have been talking about for a few different things.
Really heighten the
you gotta keep the tension,
the secrecy.
So yes, it is an undisclosed project. Well, the nature of it really has to be. But we are working on some things, and but I'll tell you one thing that I did as an experiment was to take a locally run AI system and install it on my teenager's laptop for a homework assistant. And what was very interesting is I was able to, I have very limited coding experience, but I was able to take this locally run AI system, link it to his school Gmail account, forward to an alternate email address, have the AI digest all project due dates, all relevant homework assignments, and distill that into a notepad system to create a workflow. And then he could take his phone, just like he's text messaging, and take a picture of the board of a math problem, take a picture of an assignment, and automatically create an entire homework workflow that his mother is notified about every single day. And is he using it? No. But it was a great experiment to not, okay, we have Grok, we have ChatGPT. Okay, well, let's go to the next layer of an actual locally ran custom AI bot, and let's see how powerful it is. And that was kind of my first test before going into much more impactful things to try and learn what's really going on in the world. And it is early stages, yes, but I can just simply imagine companies that have 2,000, 3,000, 4,000 employees. The inefficiencies that it's going to be able to uncover is mind-boggling. And it's like don't knock it till you try it type mentality. Until you get in the weeds and actually mess with these things and figure out, oh my God, the significance of what's happening. And it just gives me more of an optimistic outlook on the bull market continuing to be very what we would call healthy, where it's just not three companies, right?
Largely
running
due
the show.
to productivity.
Productivity gains
is the end
significant.
result of that.
And we'll get into productivity, but let's talk about oil.
So we got to talk about oil. We talked about oil last week, maybe the week before. What happened this week is a good illustration of how much uncertainty is still embedded in the energy markets. We saw on Monday 10% down on a single day. For commodity that touches everything, that's a big deal because you're not just talking about some kind of foreign, you're seeing the pump, you're seeing the price at the pump, you're seeing manufacturing costs. If you're a small business, maybe your costs are going up a little bit. That's real ripple effects that it tends to have when you're talking about market volatility, specifically in the oil sector.
Yeah, I'll my opinion, I'll push back on it.
Yeah, I expected that.
Not dismissing what has happened, what is happening. The Strait of Hormuz is still closed. It's a very, very vital, can't underscore that, a very vital corridor. Oil's elevated. 10% swings are pretty dramatic, but a few things. Oil has always been volatile. It's always been subject to geopolitical events. This is nothing new. It's always been subject to hurricanes and disruptions. But what have we seen historically oil do? It has, or rather the economy has done relative to oil shocks. It's absorbed it, and even significant ones. I mean, we've had some pretty big hurricanes disrupt the Gulf and the refineries. We've had significant oil issues occur in the past, and it does nothing to the economy in the long run. So, I really believe, honestly, as a long-term investor, and yes, it's important to focus on your sectors. It's important to focus on, are you overweight and do we need to rotate? But honestly, as a long-term investor, it's a nothing burger. In the grand scheme of things, it's just really noise. It genuinely is.
Yeah, I don't disagree with that framing of it in the long-term view. I think what I'm mostly looking at is short-term effects that it could have on, like I said, the small business owner who maybe has elevated costs associated with all of the turbulence, or maybe if you drive or something, if you're a Uber or Lyft or whatever, that you're seeing the gas price pump. That's a real world effect, and can be like a cash flow problem, and that's right now. That's not in the future. So that's all I'm saying about the framing of the long term versus short term. I don't disagree with what you're saying, though.
Yeah, I mean, it can be. Let me get my thoughts together here.
Pull them together and then push them out.
When somebody has to spend more money for gas, it's a problem, right? Now, how this ties into inflation, it's going to be a problem for them. How this ties into inflation is interesting. If you spend more money at the pump, you have less money to spend somewhere else. So you cannot push prices up by demand because you're spending more on oil. When oil filters through to the prices, the input prices of delivery and of plastics, you spend less money. So your purchasing power gets reduced. And if the money supply is not expanding at a rate to make up for that, then it does not increase inflation. And I'll give you some historical relevance for this. There's 12 notable post-World War II oil price spikes and shocks. Out of those 12, only 2 of them made their way to what you would call like a problematic inflation adjustment. Only 2.
What time frame did those take place over?
Both in the 70s.
I mean, what span of time? Was it a short term?
Well, the issue with both of those cases, one in the oil embargo in the 70s, which is what made the U.S. create the Strategic Petroleum Reserve, and then again in Iran 1.0, 79 through 81. But the problem is there was other issues affecting inflation than just oil. You had the Vietnam War spending, you had mismatched monetary policy, you had the baby boomers stepping into adulthood, significant generation demanding lots of goods and services with their demand. And so you had also the U.S. dollar going fiat, going more petrol, basically the petrol dollar, or trying to establish the petrol dollar, getting out of from when Nixon closed the gold window. So there was a lot of things that inflation went up because of, and it just so happened that during that exact same time frame where you had all these other factors contributing to inflation, there were 2 oil shocks, and those happened to be the only 2 oil shocks that actually made an impact on inflation. The other 10 did not. And it's very simply because of the fact that you have demand destruction. When oil goes up, we use less of it, and we use less of it permanently. So
we talked about that last time.
And then the simple fact that consumers have less money to spend on other things when the price goes up. So it's a self-fixing problem. And it's just that things have changed so much. Again, it's not to downplay the fact when you have things happen, nobody likes to pay more for any item. But when you're thinking from an investor's perspective and you're thinking out long-term, multiple years out, that's where, again, it's just noise.
But if there's less money for other things, that would make an argument for a slowdown in the economy. So is that going to be a shorter term slowdown in the economy, or is it going to be something that's more?
It's possible.
More sticky.
Yeah, that's a very valid point. It's possible that it could create a slowdown, but it's also possible because we're the world's largest oil producer domestically, that those higher oil prices actually boost GDP.
Oh, yeah. Interesting.
Yeah, and having spent a lot of time in the Gulf, the American Gulf states, not the Gulf states, you say the Gulf states now, everybody thinks Saudi Arabia, UAE,
the other Gulf states,
Bahrain, Kuwait, etc. We know the local impacts of Gulf states when the price of oil goes up. We know that any gently used or new F-250 or Chevy 2500 gets bought up very quickly when you're in Louisiana and Texas, et cetera, et cetera. So again, it's just you have to bifurcate your thinking. Like, you can know that, hey, this is uncomfortable and this is not, like, in a best world scenario, we don't want all of these things occurring. But then you also have to think, as it informs your investment decisions, you have to look at it in perspective. I mentioned it, and it's like beating a dead horse, but 1 out of 3 new cars bought in the world don't use gas now. It's a big deal. It's a big deal.
Yeah.
It's structural oversupply, structural demand destruction, not even discounting for the current impact. And in fact, I did read an analysis last week, just the airline disruption in the Gulf, the Arab Gulf states. The airline disruption alone is already muting about 1 to 2 million barrels a day of disruption. So just the simple fact that planes aren't flying over there is already absorbing 10% of the supply shock just in that one area. So it's a very interesting dynamic. You can read, and there are many different well thought out perspectives that disagree with me. They may be right, but that's just
caveat.
That's just the way that I look at it, because I've learned over the years to not pay attention to first order effects, always look at second and third order effects, and then look at the long-term implications. So,
yeah, well, the end takeaway here is that I think we can both agree that oil seems to be functioning as the market's real-time confidence gauge on diplomatic scenarios.
Absolutely.
And so
100%,
anything that happens with oil, whether it's a ceasefire or a negotiation or a denial of a negotiation or whatever, it's going to move the price. And what we have seen over the past few weeks is that when oil goes up, the market tends to go down. When the market goes up, oil tends to go down. So I don't even know what's oil trading at today. I mean, it's up a little bit today, but
West Texas, I think, is like 97, 96.
Yeah. I mean, so we're very similar where we were last week, despite the headlines,
the big swings and things.
Despite everybody, screaming that the sky is falling. So I mean, I think it's like, this is segueing into the next.
So if you're on
Kalshi,
if you're on Kalshi or Poly Market and you're a bettor, you want to use oil as your gauge to bet on the diplomatic outcome, because you'll probably see the price movements there first. If that thesis holds, which I'm not advocating for anybody to go bet on Kalshi or Poly Market, but.
Yeah, knock on wood. But looking at it in that scope, kind of changes the way that you should be consuming financial news right now, in any kind of financial news. What we saw this week is the market isn't really trading on earnings or economic functions. So it's trading strictly on headlines. It's a very hard market to trade. Headlines are fast. Often they're contradictory. Sometimes they walk themselves back. So it's like, how do you trade that? Back to your point about the short-term trading.
You do not do it. Short-term trading is a losing game. You don't do it. So if you're thinking of being a short-term trader, don't. Number one, there's your advice. I'll give you that advice. Ignore the disclosure. There's your advice. Don't do it. Number two is, if you've already made the important and very rewarding step of getting into the market, being allocated, trusting the process, trusting your retirement plan, trusting the investment plan that your advisor has set for you, you do not need to be checking your account balance every day. It's not productive. Because we've already laid the framework here in this discussion that these short-term price movements do not reflect long-term reality. And so when you're seeing those price fluctuations, you do not want it to try to lead you to make a decision that's going to be detrimental to you 5, 6, 7, 8, 9, 10 years. And if you've already done that and you've committed that grave sin of checking your balance too often, what you want to do is go to Yahoo Finance, type in SPY, very simple, type in Dow, type in Amazon, whatever, Apple, and then hit the max button and then try to find a point on that chart.
Yeah, zoom out.
Yep. Try to find a point on that chart where it was a bad day to get bad time to get invested.
Yeah, I mean, you have 5 days right now. We're on Friday. So you have the market was a full market week this week. So if we look back, Monday, you got the market up on a ceasefire headline. Tuesday, you got it down when Iran pushed back a little bit. Wednesday, it kind of bounced on news that there was that formal proposal that didn't end up moving forward. Thursday and Friday, kind of giving it back as tensions sort of creeping up again. So if you were reacting to each of these moves, you're probably exhausted. You're at your wit's end, and maybe you have a few decisions that you've made in you're kind of in regret mode, and that's just with 5 trading days.
Yeah,
so that's it.
Yeah, that's crazy. The thing is, the fundamentals of those companies did not change 4 times last week. Coca-Cola did not change its outlook 4 times.
Yeah,
it just didn't. It just didn't. So it's refreshing, and these are things that every investor needs to always remember, regardless of your investing history. Maybe you've been too aggressive in the past and you've seen some drawdowns and then you've recovered from it. Maybe you've been too conservative in the past and you've recently increased your risk tolerance. It's just always important to zoom out, trust the process, and I can't tell you how many clients we have seen benefit from that approach, regardless of where they're at in life and when they started investing, is to always zoom out, trust the process. And the name of this game is for, over time, your number to go up so that you can enjoy the retirement that you've had. You can enjoy those dividends and that growth and that income and participate in this economy. And, that's why we always say, the old saying was the rich get richer and the poor get poorer. The best way to look at it is that people that own assets end up getting a bigger piece of the pie than people that don't. And so you've got to get in the game, and then you got to trust that process and don't be manipulated out of it based on news, short-term traders, hedge fund activities, market manipulation, wherever it may come from. And it's a tough lesson to learn, but it's a very important, if not the most important lesson to learn when it comes to finances. That and stay away from credit cards.
Yeah, one thing you touched on that I do want to highlight is the importance of kind of figuring out what your risk tolerance is. A huge portion of investing and a huge portion of the success of any potential retirement plan. Because if you get in an environment where you're uncomfortable, maybe it's a little too aggressive for you, maybe you're seeing swings that you don't necessarily want to see, it can lead you to make decisions that maybe are not the best decisions to make in that specific situation. Mm-hmm. So a lot of times what we do with our client base, or we have new clients that come to us, maybe they don't have a lot of experience, maybe they've had a 401k for 30 or 40 years that they've paid into that they haven't really kept track of, they haven't watched it, but now they've got 6 or 7 figures when they retired and they want to know what to do with it. Oftentimes we'll start kind of on a low risk tolerance, and we'll let that client get accustomed to the process and how it works over the next year or so. There's no real time frame there. And then eventually what happens with most of those people is they come during one of our annual reviews and they'll say, hey, I think I'm comfortable now. We can kind of up the risk tolerance. And that happens a ton. But it's because we started out in a level that was comfortable for them. Not necessarily they're not going to be put at a disadvantage because it's not like they're, in a CD or something. They're still in the market. They're still getting decent returns, but they're at a place where they're comfortable and they feel in the driver's seat. So that cannot be overstated. I'm glad you brought that up because that's like a huge deal. Yeah.
And it's perfectly okay. It's okay for your risk tolerance to change. You just need to make sure that risk tolerance change aligns with your goals and that you don't have unrealistic expectations to the downside or the upside.
Right.
And you can scale that up. It's perfectly fine.
And the flip side of that is also true. Sometimes your risk tolerance doesn't have to change. Just because you go from accumulation and working and saving into a 401k into retirement, you don't necessarily have to get super conservative. That's another kind of misconception that people have. You can continue to be a growth investor in retirement. I mean, people are living a long time in retirement, 30, 40 years in retirement. Some people are retiring early. So if you retire in your 50s, you probably need to be a little bit more aggressive than you otherwise would.
That's writ large outside of anybody's specific situation, which we know there are variables at play that could change that specific advice. But when you zoom out and you look at it, to take your foot off the gas of growth once you've actually made it to the amount you need to retire is the whole point of saving that money was so that you'd have the income and the assets to last you in retirement. So if you let your foot off the gas and just completely give up any growth, what was the point? Because inflation is just going to eat it away. Even at 2% a year over in 10 years, if you've saved up $1 million in 10 years, that million's only going to be worth $800,000. And in 20 years, it's only going to be worth $600,000.
Yeah, it's the importance of making good decisions and making, having these conversations with whoever you have that's on your side that's helping you with this. That is super important. Can't be understated.
Yeah, absolutely. Well,
again, rabbit trail, and that wasn't even the planning section.
It was not. Let's look at. We got some big changes coming up to the Fed.
We do have big changes coming up to the Fed. So the Federal Reserve, we talked about a couple weeks ago. Actually, it was last week. We talked about the market is now kind of not necessarily pricing in rate hikes. You'll see a lot of people talk about that. I don't think that's an accurate representation, but if it is, it's an accurate representation of this moment in time, not anything that could happen in the future. We'll talk about that, but we have thus far had the market kind of price in 2 rate decreases for this year, and it's largely gone if you're talking about the market itself pricing those in. So I would still say that we're probably in for some rate cuts later in the year, but we have a lot of analysts looking at the markets right now and saying that the probability of a hike has definitely increased.
Yeah, I don't buy that.
Yeah, I didn't figure you would.
It's just the long-term direction of rates is down. The level of government debt, the way that the world economy in general is set up, rates are coming down over time. The only path for rates is down. That's the only thing that makes logical, mathematical, long-term sense. And if it makes sense, you stand the chance of making dollars. Just saying. So more importantly,
you should put that on a sign or a T-shirt.
The more importantly right now, short-term moves we've already talked about. 90% of the times this has happened with oil. There has been no impact to inflation. So I think the more important aspect of what's happening now is the new leadership that's coming in that changes everything.
Yeah, I agree with that. I don't think that I'm not necessarily of the opinion that I don't know how many rate cuts we'll get. And it's all going to be dependent on Kevin Warsh, which is the guy that's coming in. Is that how you say that? Warsh. I feel like I'm saying that
very
wrong.
Irish. Yeah. Hard R there.
Well, Warsh here in the South might mean something different, like you're washing your clothes or something.
Yeah, that would be some of my.
It feels wrong to say Kevin Warsh.
My family members from back in the day that had that North Georgia appellation hard R's, tires and fires and washing.
So Warsh.
Yeah, what are we talking about?
Kevin Warsh is his name.
Okay,
he's coming in to replace Jerome Powell in May, right? Is it May? Yeah, his term ends in May.
It may happen in May.
It may happen in May. So we kind of know where Kevin Warsh stands on this. What have we heard from him say on interviews and radio shows and stuff like that?
He has been very public. First of all, let's give some context as to who he is.
Give us context.
So, I had it here.
The thoughts. Put them together. I'm really having to coach you through this.
I had it, but now I've scrolled, I think, too far.
Well, I think that
here it is. He's been at the Fed before, Stanford and Harvard educated, very respected on Wall Street. Jamie Dimon, a big fan. And then you even got some kind of tech influential people such as Mark Andreessen that really like it. So you have kind of non-political Wall Street kind of apparatus that does like it. You have his educational background, his academic background. He does fit very well with the Fed. So that's kind of the context.
Well, I think the overarching thing is like all you have to look at is what Trump wants. The Federal Reserve is supposed to be a non-political, there's a whole argument to be made, and that's not for this podcast and certainly not for another one, but there's an argument to be made that it is or isn't, depending on your political views. But you just have to look at what Trump has said he wants, which is lower rates. So obviously he's going to pick somebody who wants that as well.
Yeah, I mean, the disconnect there is that in the past, Kevin Warsh has been very hawkish as it pertains to Fed policy. So there is a disconnect with that. But if you read between the tea leaves and you start, or if you read the tea leaves, I don't think you read between the tea leaves, but if you
read the tea leaves,
you read the tea leaves or read between the lines, he does have a dovish tilt, but it's as it pertains to economic productivity. That's where it gets very interesting. Mm-hmm. If you go and listen to his statements and read his things that he has written, you're going to see he's not a big fan of balance sheet expansion, but he is a fan of lowering interest rates if productivity gains are increasing. And that is where things get very interesting. That's where I think can reinforce the thesis that rates are going to continue to go down, and they may go down much quicker and much faster than people expect. He has said specifically, quote, the most productivity enhancing waves of our lifetimes, past, present, and future, is represented with artificial intelligence, fundamentally changing the speed of innovation and boosting American competitiveness that will lead to higher real wages. He believes that just a single percentage point in annual productivity growth, which there are arguments to be made that a single percentage point is orders of magnitude less than what we're probably going to see, but just a single percentage point increase in productivity will double the living standards within a generation. That creates a significant deflationary force that cannot be ignored. So Alan Greenspan, most recent example of this was the productivity boom that came from the internet age. And he was able to consistently and methodically lower rates, even though the economy was expanding at a very rapid pace and inflation went down. So we have historical precedent for this, and it's very interesting. It'd be very interesting to live it, to see how it plays out. But I believe that's the viewpoint he is bringing is not one to be accommodative for the sake of being accommodative, regardless of the White House or the Congress, because he's going to be there for 10 years. He seems to have a very interesting view of the institution of the Fed and its purposes. And he just so happens his view on productivity happens to align with the current desire for rates to go lower.
From both the administration and the Treasury, actually.
Yes, from both the Treasury, which the more important aspect of it is really the Treasury. That I think that has more weight than which political figure is saying what when. I think that the Treasury is much. We can get into that in a later discussion in a later podcast.
It's a significant shift if he actually is in the chair position, which he's going to be. He was nominated. I guess he'll go through the confirmation process. But the bigger question is, there's a lawsuit going on right now with the Federal Reserve and Jerome Powell, and specifically the Trump administration has brought a lawsuit against them, and Powell says he's not going anywhere until that's resolved, and so that doesn't mean he's going to be the Fed chair, but he'll be on the board. So how much of a power does he bring to his position of being able to kind of, I don't know how you would describe that, throw a wrench in the works. It's all that comes down to voting. So everybody has a vote, but if you're having the former Fed chair that's sitting in the chair with you while you're conducting the Fed meetings, I'm sure that's going to, embolden some people to maybe vote a certain way or something. So I'd be interested to see how that happens.
I think that there's probably always things the public sees and things the public doesn't see. And these institutions, all of them, I mean, they've been around for the U.S. government 250 years this year. The Federal Reserve's been around 113 years. So I think there are things that are out there, headline and political back and forth that goes on.
I mean, even I think some of the senators are saying they're going to hold up his confirmation until the lawsuit is resolved. So I'm just curious, like, does it make more sense for the Trump administration to just get rid of it, because that gets rid of a large part of the issues that they supposedly have with the Federal Reserve?
I don't know. I don't keep up much with all that. I just, it's not very interesting to me, the back and forth stuff. But I think that what little I do know is that it stemmed from something with the Congress or one of the Senate committees about the Fed's budget or something, building, this or something.
Well, they had that interaction on camera where Trump says, hey, I got this, the building was $1.3 billion or something. And Jerome Powell was like, no, I don't think that's right. And he gets one of his staffers to hand him the paperwork. It's all from that. Yeah. But the question is, should you dig your heels in on that? Or should Trump dig his heels, or the Justice Department dig their heels on it? Or should they just kind of wash their hands of it so that they can move on? Because as long as they kind of hold it up, which is what I'm reading of it, my interpretation of it, as long as they hold it up, Powell's going to be like, I'm not going anywhere. I'm not going anywhere. What's that mean with Leonardo DiCaprio is like, I'm not going anywhere. But he's not going anywhere. So why would you just, the Wolf of Wall Street? Yeah. Why would you just, I
don't know.
Why wouldn't you just let it go? That's the question.
I mean, my opinion for all of this type of stuff is that all of these people, all of them should be conducting themselves in a manner that always puts forth the interest of the people. And that's probably
but that's just not the world we live in.
It is not the world. It is not the world, which is why I choose not to digest much of any of this stuff.
Well, it's interesting.
Yeah, it is interesting.
The potential ramifications.
Yeah, but long-term view, the back and forth, all of those things, as the pendulum swings one way and then the other, the long-term trend of rates is down. It is. It's like gravity to a lead balloon. It is a mathematical reality, and nothing is going to change that.
I think that's a good takeaway.
I do think an interesting aspect of it is I think the public is not very aware, and because I think most people do probably ultimately, when you're sitting at the kitchen table, view it as I think I would view it. Maybe that's just a bias that I have in thinking that I would like for most people to view it that way, in a very low pressure. Again, everybody should really just be acting in the interest of the American public. But I think ultimately the American public is probably. That'll be my platform. just boring. What is the movies they used to show you when you were in school about how the government works?
Yeah, the bill,
so School Rock.
School Rock. Yeah,
something like that.
Is it School Rock? Maybe. Yeah,
something of that nature.
I'm sure somebody will.
I don't know. Maybe it'll be popular one day, just like normal government stuff.
I wish. But your mouth to God's ears.
But the American public, I do think, is not very aware of how the Federal Reserve operates.
Of course. So, it's meant to be that way.
Yeah, they do print their own money out of thin air in general. So it is a very shocking realization. And the Federal Reserve is about as Federal Express is. Yeah. Most people don't realize that. It is more of a private institution than what most people are led to believe.
Yes. A book recommendation for anyone who wants it, but they're not going to read it.
Because it's that thick.
Yeah. The Creature from Jekyll Hyde, which is about the
Jekyll Island.
Jekyll Island. Yeah, sorry. Why did I say Jekyll Hyde? Yeah, Jekyll Island.
Dr. Hyde and Jekyll, Dr. Jekyll and Mr. Hyde. That's probably where it came from.
That's
Jekyll
the creation
Island.
of the Federal Reserve. And it talks about the bankers meeting and taking secret transportation to the island. Yeah. It is a long book, though. And I think it's available on Audible, so somebody can read it to you if you want to do it that way.
And you know what? It has been, and this is where you take perspective, and we can't take for granted the world that we live in, especially here in America, and the growth and everything that's taken place. I mean, the Federal Reserve has played a significant role in guiding us through from FDR's gold policy to Nixon's gold policy to the
Which
fiat
FDR
world,
gold policy? Because he had several.
But the confiscation of gold and then the subsequent revaluation of it, and then it has been kind of it has become an institution on equal weighting with the U.S. Senate as far as how well respected and how successful it has been, given the circumstances it's been handed from the politicians over the decades. But I think that goes into what you're saying, which is a lot of people are paying very close attention to it, as because of its status and things that are happening. But you can only control what you can control. I think that long term we can control our perspectives on the market, and we can hold our biases and see kind of where they land. But I do believe that we are increasingly inching towards that world where if you've been waiting to buy a house, if you've been waiting to refinance your personal or your business debt, those rates are dropping. They are getting lower, and I do hold the belief that this time next year they will be lower than they are now. And I believe that at the end of the day, everything else that's going on will just be noise, with the exception of the AI-driven productivity gains that we're seeing happen. Chart that out. You can use any LLM and say, take something that you've learned about a company that is using artificial intelligence. Look at their earnings report. Take that and say, I want you to extrapolate this out to the entire U.S. stock market, and what implications would that have? And you will be shocked. You will be shocked at that output.
Yeah. I mean, you'd have to make sure that you're trying that with the right company. But yeah, well, I mean, if we move into kind of pivot, now we're going into our sort of planning topic of the podcast before we wrap it up. We're kind of going a little long again this week, but we are going to call this segment the planning room. And it's just where we kind of take an honest look at sort of planning concerns or concepts, and talking about interest rates, talking about the effect that interest rates could have on decisions that affect you in retirement. We're kind of looking at that discussion of pension versus a lump sum. A lot of people have this question. A lot of people are coming into this scenario. A lot of people have companies that are offering buyouts if they want to get that off their balance sheet. How should they go about thinking about that?
So a really great thing about interest rates coming down is you will get better buyout offers on your pension. And it's something to take very seriously. We generally see that through consultation with us, clients are able to really better their financial situation much more than they thought possible by looking at buyout versus pension. And so we've started seeing an increase of pension buyouts. So if your company is offering you that, it doesn't cost you anything to book a consultation with us and have a conversation to figure out what makes sense for you in your specific situation. But with interest rates having come down and continuing to go down, you're going to see an increase in buyout offers, and those buyout offers are going to be more than you thought they would be. Falling interest rates puts a lot of pressure on pension obligations.
And we should note here, too, that there's no right or wrong answer in this situation. We meet with people all the time that have different needs, different situations. Maybe you're in a different health environment than one of your peers. All of these factors will go into making this decision about, should I take a lump sum pension or should I take a buyout? Should I take the lump sum pension or should I just have the pension come to me?
Correct.
There's also decisions that are even further down from that. Do I want it to be my life only? Do I want it to pay a little bit to my beneficiary, to my spouse or someone like that? And so all of it is a very nuanced conversation. When you're looking at a pension, you're looking at sort of that idea of certainty. You get a paycheck every month. Is that paycheck going to keep pace with future inflation? That's a bit of an unknown there. It's sort of that conversation about trading control for certainty. So with the pension, you have a lot of some of that uncertainty is taken away because you get a paycheck consistently every month. The lump sum option gives you a little bit more control over it. It's a bit more freeing to think of it that way. And you could think of it from a legacy perspective, because a beneficiary doesn't just have to be your spouse. It could be any of your heirs. Yeah.
So, the lump sum being a large upfront payment gives you control of that money. It is now part of your estate, typically, and obviously that is rolled into an IRA. I will say generally, because you can't take this as advice. We have to look at your specific situation. And then you invest it how you see fit. And then it's yours, and you live off of it, and you enjoy the growth. So we know, we're not going to say here because we don't want it to be taken as investment advice, but me and you know mathematically where most people are going to benefit. Now, we have seen situations that are outliers. We take the approach that everybody's situation, we act like it's brand new to us. Let's look at the math. Let's do the calculations. Let's solve for these qualitative aspects of estate, control, dialing up and down income, these types of things. But it's very important to talk to somebody that knows what they're doing with this, because it can be a game changer for you. It really can, but it needs to be looked at sober-mindedly with a lot of perspective. Because once you make the decision, it's unmakeable. I mean, once you do it once, you can't change it.
And there's a lot of variables that go into it. We mentioned health. We mentioned marital status. We mentioned additional income beyond the pension. Maybe you have Social Security. Maybe you have another pension from another company. Maybe
the current debt load you have.
Yeah, there's a lot of factors that go into making that decision. Risk tolerance is another one. There are certain scenarios that exist where maybe you take a lump sum and you roll it into another account, and then you continue to watch that grow. So in some scenarios, the math works out to where you can get what the pension promised you, maybe a little more, depending on what your risk tolerance is. So it's a very nuanced conversation. It's not had very much anymore because pensions have largely not been used very much. I think IBM was in the news recently because they're actually starting like a cash balance plan pension back up instead of the traditional 401k. But we are seeing a lot of people have the option to buy out the pension. And we do still have we saw a couple examples this week of clients that are actually going to get a pension offer. And so it does happen. It is out there. If you're getting close to retirement, you may be in that position. We would encourage you to reach out and talk to somebody. Certainly reach out to us if you feel comfortable doing that, but reach out to somebody that you trust that can help you make that decision.
Yeah. It can be a life-changing thing. It can be a pretty big deal. So you absolutely need to do that. Understand your options. Understand your flexibility. And at the end of the day, it's your money. You're responsible for making the decisions, but you don't have to make them alone. And we can always go through the math. It'll take us 10 minutes. So just reach out and have a conversation with us. Well, we have gone over.
Yeah, we always do. We'll let you get back to whatever you got going on. We are going to look ahead sort of to next week. We've got some real world data that's going to come out. The first kind of release of data that's going to be incorporating all this stuff with the oil. So that'll be interesting to look at, something to look forward to next week, which I think it's next Friday, April.
Next Wednesday is April.
Yeah, but next Friday. Yeah, next Friday will be the show. So we'll do a monthly roundup next week, the first week of the month. But anyway, we'll leave you with kind of the feeling that the market is still noisy. Lots of headline movements. Diplomatic situation is unresolved. More headlines moving in both directions. It can feel sometimes like a lot.
Yeah, and we've talked about a lot of things in this podcast that can be headline driven, and we obviously don't have information about decisions going on at the Federal Reserve. We're just taking and digesting the data, looking at precedent, looking at statements, looking at mathematical possibilities, historical realities. And uncertainty is not the same as danger. We can have an opinion and can be wrong. We can have opinion and be right. But at the end of the day, a good, well thought out plan is agnostic to your opinions and your biases. It's a plan and it's a strategy. It's step 1, step 2, step 3, and we execute it. And you know what? If you're wrong, you learn from that. And if you're right, you say, well, that was interesting, but I may be wrong next time. And I approach it with humility. And that's what you have to do. And don't get wrapped up in these geopolitical issues and these domestic uncertainties, oil being elevated, the Fed in a complicated spot. Every single time the story eventually moved forward and the companies that you own, they're still doing business. They're still serving customers. They're still generating excellent earnings. And any period of time, or a few weeks and days, whatever, of headlines does not change or alter that.
Yeah, well, that's a good way to end it. That's been good returns for this week. Thanks for spending time with us. Time out of your day. Good conversation, useful information. We hope to lead to some good outcomes for people, answer some questions, make them think. Anyway, subscribe if you haven't. Share it with somebody who you think will find value in it. And as always, we will see you next week.
Yeah, absolutely. Take care.